All right, let's face it, health insurance, it's a jungle out there, right? Trying to figure out all those crazy acronyms and different plans, it can be super overwhelming.
Yeah, it really can. It's like you need a special decoder ring just to understand the basics.
Totally. That's why we decided to, break it all down for you in this deep dive. Specifically, we're focusing on health insurance providers.
Right on. We've got this amazing chapter packed with information about all sorts of provider models, plans, all that good stuff.
Yep. And we're going to cut through all that complicated jargon and give you a clear picture of how these different providers work.
You might even be surprised by some of the differences between them, the kind of things you wouldn't normally think about.
Totally. Okay, so first things first, we got to lay down some groundwork, some basic definitions, kind of like our cheat sheet for understanding all this stuff. So let's kick things off with adverse selection. Sounds a bit intimidating, doesn't it?
A little bit, but it's actually a pretty straightforward concept. Basically, it's the idea that folks who know they're more likely to need health care, they're the ones who are more likely to buy insurance.
Makes sense, right? The
Yeah.
people who think they'll need it are the ones who are going to go for it.
Exactly. And insurers, they got to be really aware of this to make sure they have a good balance of people in their risk pool.
Okay.
Got to keep things stable.
Yeah, so they don't end up with a bunch of high-risk people and not enough low-risk people to even things out.
Exactly. Now, another key concept is the difference between community rating and experience rating. These are two ways that insurers figure out what to charge for premiums.
Okay, so community rating, that sounds like it's looking at the big picture,
You
right?
got it. Community rating considers the overall health costs in a specific geographic area. So for smaller groups especially, their premiums are often based on this community rating.
Okay, so like a small business, their rates would be tied to the general health of the community where they're located.
Precisely. Whereas with experience rating, the insurer looks at a specific group's own history of medical claims to determine premiums.
So bigger companies, their rates are more about their own employees' health history rather than the whole community.
Exactly. It's like a more personalized approach to pricing based on that group's track record.
Gotcha. Now, what about this creditable coverage thing? Sounds kind of important.
Oh, it definitely is, especially if you're thinking about switching health plans. Basically, creditable coverage means you've had health insurance in the past without a big gap in coverage. Usually, anything less than 63 days is considered okay.
Okay, so less than 2 months without insurance, you're good.
Right. And having creditable coverage can really help you avoid those pesky waiting periods for pre-existing conditions when you join a new plan.
Oh, that's a huge relief, especially if you've got something you need covered right away. All right, last definition on our cheat sheet, change of life event. We all know what those are, but what do they have to do with insurance?
Well, these big life changes, like getting married, having a baby, or even getting divorced, often mean you need to update your insurance situation.
Yeah, for sure. Your needs change, so your coverage probably needs to change too.
Right. So, health plans typically offer these special enrollment periods outside of the usual open enrollment times. These let you make adjustments to your coverage based on those big life events.
Gotcha. So it's like a safety net, making sure you're not stuck with the wrong coverage just because life threw you a curveball.
Ah,
Okay, now that we've got our definitions down, let's dive into the actual providers. First up, we've got the classics, Blue Cross and Blue Shield. Seems like they've been around forever.
they really have. They've got a fascinating history, actually. A lot of the original Blue Cross and Blue Shield organizations were set up as nonprofits.
Really? I
I
didn't know that. I always thought of them as big insurance companies.
Well, they kind of are, but with this unique twist. Many started out as service providers, meaning they directly paid the doctors and hospitals in their network for the care their members received.
So it's not like the patient pays and then gets reimbursed by the insurance company.
Nope, it's more direct than that. And traditionally, Blue Cross focused on hospital coverage, while Blue Shield took care of the physician side of things.
Okay, so they had their own specialties, but they often work together now, right?
Right, and they actually still have separate organizations in some areas because of that historical division.
Interesting. Now, the chapter mentioned something called usual, customary, and reasonable charges, or UCR. What's that all about?
So UCR is basically the amount that Blue Cross and Blue Shield determine to be a fair price for a given medical service in a particular area.
Okay, so it's like a benchmark for how much things should cost.
Right. And providers in their network, they agree to accept the UCR amount as full payment, although patients might still have copays or deductibles on top of that.
Right, gotta love those extra costs.
Right.
And another thing, Blue Cross and Blue Shield, they don't call their members policyholders, do they?
Nope, they call them subscribers. And their plans are often called prepaid plans because, well, you pay a fixed monthly premium in exchange for a specific set of benefits.
It's like subscribing to a service, kind of like Netflix or something.
Exactly. And it's important to remember that those doctors and hospitals in the Blue Cross and Blue Shield network, they have a formal agreement about what fees they'll accept. It's all laid out in a contract.
Okay, so it's a pretty structured system with like clear expectations on both sides.
Gotcha.
Now, let's switch gears and talk about another type of traditional commercial insurance companies, sometimes called indemnity plans.
All right, so these are those big national companies that many folks think of when they hear health insurance. They sell those major medical policies.
Yep, the more traditional insurance model, right? Like you pay a premium, you get coverage.
Pretty much. So these commercial insurers, they could be life insurance companies, casualty insurance companies, or companies specifically focused on health insurance. And their main thing is they reimburse the insured person for healthcare expenses.
So you pay the doctor's bill, and then the insurance company pays you back.
That's the general idea. However, a lot of these policies have something called the right of assignment, which means you can actually tell the insurance company to pay the doctor or hospital directly.
Oh, that's way more convenient. No more waiting for reimbursements.
Right. Much smoother. And these plans, they're also called indemnity plans because they indemnify you, basically. They compensate you for the financial hit you take because of medical expenses.
So they're like your financial backup when it comes to healthcare.
Yeah.
But the chapter mentions hospital indemnity plans too, which are different, right?
Totally different. Hospital indemnity plans, they pay you a fixed amount per day if you're hospitalized, regardless of what your actual bills are. It's like a little extra cash to help with expenses, but it's not the same as comprehensive health insurance.
Right. It's more like a supplemental thing.
Yeah.
And another difference with these commercial insurers is that they usually don't have specific networks.
Yeah. You got it. They typically have a national scope, so you can choose any doctor or hospital you want. More freedom, but you might end up paying more out of pocket depending on your plan.
Okay, so more choices, but potentially higher costs. That's a good trade-off to keep in mind.
Okay.
Now, the chapter moves on to managed care, which sounds like a whole different ballgame.
It is. Managed care came about as a way to, try to rein in those skyrocketing healthcare costs.
Yeah, because healthcare can get crazy expensive.
Mm.
So how does managed care work?
Well, it involves a bunch of different strategies, all aimed at managing costs. One of the most common ones is deductibles. That amount you got to pay out of pocket before your insurance kicks in.
Yeah, those are fun. Not.
Definitely not. But they help reduce the number of small claims the insurer has to process. Then there's coinsurance, where you pay a percentage of the cost after you've met your deductible, up to a certain limit.
So it's like sharing the cost burden.
Exactly. And they can even use things like limiting how long they'll cover a hospital stay to control costs.
Right, like trying to make things more efficient. And they also do stuff like requiring second opinions before certain surgeries, right?
Yep. Mandatory second opinions are pretty common. It's all about making sure those surgeries are absolutely necessary and avoiding unnecessary procedures.
Which makes sense, both for the patient's health and for saving money. And speaking of saving money, preventive care seems to be a big focus in managed care.
Huge focus. Things like regular checkups, vaccinations, all that good stuff. It's all about catching things early and preventing bigger problems down the line.
Which, in the long run, can save everyone a ton of money and hassle.
Absolutely. And another thing you see a lot in managed care is ambulatory surgery.
Ambulatory? Sounds fancy. What's that?
It's basically just outpatient surgery. Doing procedures in specialized centers instead of hospitals, which helps cut down on those expensive overnight stays.
Oh, so it's like a more streamlined approach.
Yeah.
Makes sense. And then there's this whole case management or utilization review thing. Sounds a bit intense.
It can be, but it's all about making sure you're getting the right care in the right setting. So the insurer might have nurses or other healthcare professionals who look at your treatment plan, make sure it's appropriate and cost-effective.
So they're like your healthcare advocates, making sure everything's on track.
Exactly. And these reviews, they can happen at different stages. There's prospective review, which is before you get certain treatments, like elective hospital stays. You often need approval from the insurance company beforehand.
Oh, so that's what pre-authorization is all about.
Yep. And if you don't get it, they might not cover the costs, or they might pay a lot less. So definitely got to get that squared away in advance. Then there's concurrent review, which happens while you're actually getting care, like during a hospital stay. They monitor the treatment, make sure it's all good, and help plan for your discharge.
And lastly, There's retrospective review, which
Mhm.
happens after the care has been provided.
Right. With retrospective review, they look back at the care you received. It's not about denying payments that have already been made. It's more about looking for patterns and figuring out ways to manage costs better in the future.
Okay, so it's like a continuous improvement process. Gotcha. Now, let's dig into some specific managed care networks, starting with HMOs, health maintenance organizations.
All right, HMOs, they're super common, especially for folks getting insurance through their jobs. They're a bit different from those traditional indemnity plans we talked about. An HMO, it's an organization that actually provides the healthcare services to its members for a fixed prepaid fee.
So they're not just paying for your healthcare, they're actually delivering it too.
Exactly. They're like a one-stop shop for your healthcare needs. And they can be for-profit or nonprofit. The nonprofits might operate more like cooperatives, while the for-profits could be run by physician groups or other entities.
Okay, so different structures,
Yep.
but the same basic concept. And the chapter mentions that HMOs are regulated at both the state and federal levels. What are some of those regulations that folks should be aware of?
Well, there are rules in place to make sure you have access to care 24/7, for emergencies and stuff. And most HMOs have to have an annual open enrollment period. Then at the federal level, if an employer is offering an HMO, there are rules about the minimum number of employees they need to have, how much the employer has to contribute to the premium, and the HMO can't cost more than a comparable traditional plan. There's also a big emphasis on preventive care and family planning services, and HMO's got to keep enough money in reserve to cover potential costs.
Wow. So quite a bit of oversight to make sure things are on the up and up.
Mm.
Now, what are the key things that someone who has an HMO or is thinking about getting one needs to understand about how they work?
All right, so a few things to keep in mind. First, HMOs offer comprehensive care. That means they cover a wide range of services, pretty much everything considered an essential health benefit under the ACA, though usually not routine dental or vision.
Okay, so it's pretty thorough coverage for most healthcare needs.
Yep. And it's prepaid care, meaning you pay that fixed premium, usually monthly, and then you typically have copays for different services. Those help cover the administrative costs.
Right, those little fees you pay at the doctor's office.
Exactly. And HMOs, they put a big emphasis on preventative care, regular checkups, screenings, all that good stuff. That's often covered without even having to meet a deductible.
So it's like they're incentivizing you to stay healthy.
Totally. Now, another big thing about HMOs is the gatekeeper system. This is where your primary care physician, your PCP, plays a really important role. They're your main doctor, the one who coordinates all your care.
So if you need to see a specialist, you got to go through your PCP first.
Yep, they're the gatekeepers, making sure you get the right referrals and that everything's coordinated. It's a way to manage costs and ensure you're getting the most appropriate care.
Makes sense. And HMO networks are usually local or regional, right?
That's right. Unlike those national commercial plans, you're kind of limited to providers within a specific area. Now, if you have a real emergency, you can go to any hospital, but you got to notify your PCP as soon as possible.
Okay, so in an emergency, network rules kind of go out the window.
Exactly. Now, there are a few different ways HMOs can be structured. You've got closed panel and open panel models.
Hmm.
In a closed panel HMO, like the staff model, the doctors are actually employees of the HMO, and they work in facilities owned by the HMO.
So it's like a self-contained system.
Exactly. Then there's the group model, also closed panel, where the HMO contracts with one big physician group and pays them a set amount per member. That's called capitation.
Okay, so the group gets a fixed amount to cover all their patients' care.
Right. And then you have the network model, similar to the group model, but with multiple physician groups contracted. Now, open panel HMOs, like an individual practice association or IPA, they work a bit differently. They contract with a network of independent doctors who have their own private practices.
So with an open panel, you have more choices of doctors.
Exactly. You're not limited to doctors who work directly for the HMO.
Gotcha. And the chapter briefly mentioned dental maintenance organizations, or DMOs. Are those like the HMOs of the dental world?
Pretty much, yeah. DMOs work in a similar way to HMOs, but focus specifically on dental care. You pick a primary care dentist within the network, and they coordinate all your dental care and referrals to specialists if needed.
Okay, so same concept, different specialty. Makes sense. Now let's move on to PPOs, Preferred Provider Organizations. These are super popular too, and you often hear people debating between HMOs and PPOs.
Yep. PPOs are another big player in the managed care world. They're a bit different from HMOs in that they don't actually provide the healthcare themselves. They build a network of providers doctors, hospitals, and clinics who agree to give PPO members discounted rates on their services.
So they're like the middleman negotiating lower prices.
Exactly. They're all about the financing and the network building. They don't directly deliver the care like HMOs do, and they typically offer a wider selection of doctors and hospitals compared to most HMOs.
Okay, so more choices, which is
Yeah.
always good. And within that network, it's a fee-for-service model, right?
Right. You see an in-network provider, they bill the PPO for the services they provided, but at that pre-negotiated discounted rate. And as a PPO member, you usually have co-insurance. That means you pay a percentage of the cost for those services after you meet your deductible up to a certain yearly limit.
Okay, so that's how the cost sharing works.
Yep. And it's a bit different from HMOs, where you typically have those fixed co-pays, which are more for covering administrative costs. Also, with HMOs, they take on more of the utilization risk. That means they pay a set amount even if you don't use any services. PPOs, they only pay for the services you actually get.
Makes sense.
Yeah.
Now, what if you want to see a doctor who's not in the PPO network? Is that even allowed?
Yeah, that's one of the big perks of PPOs. Unlike a lot of HMOs, PPOs usually let you get care from out-of-network providers, but it'll probably cost you more.
So there's that trade-off again, more choices, but maybe a higher price tag.
Exactly. You might have a higher co-insurance percentage, and the provider might not be bound by those discounted PPO rates. However, if you have an emergency, you're usually covered at the in-network rate, even if you go to an out-of-network hospital.
Okay, so in a true emergency, network restrictions are more relaxed. Gotcha. Now, what about referrals? Do you need those to see a specialist with a PPO?
Not usually. That's another advantage of PPOs. You typically have direct access to any specialist in the network without needing a referral from your primary care doctor. Saves you time and hassle.
More freedom and flexibility. Nice. And the chapter mentioned that some PPOs are getting even more innovative, offering things like dental and long-term care coverage.
Totally. PPOs are always adapting, trying to meet people's needs. Some now offer these more comprehensive packages, which can be a huge plus. And all that flexibility, the in-network and out-of-network options, plus the direct access to specialists, makes DPOs a really attractive option for a lot of folks.
All right, so HMOs and PPOs, we've got those down. Now, what about POS plans, point-of-service plans? They sound like they try to blend the best of both worlds.
They do. They're all about combining features from indemnity plans and HMOs. Basically, they give you a choice in how you want to get your care. You can stick with the POS network, like an HMO, or go outside the network.
And the coverage level depends on which path you choose, right?
Exactly. If you stay in-network, you'll usually get the best coverage. This typically involves picking a primary care doctor who coordinates your care, kind of like an HMO. But if you decide to go out of network, you'll likely face higher out-of-pocket costs, probably higher co-insurance, and the plan might not pay the full amount the provider charges.
So you get the potential savings of an HMO if you stay in network, but you have that escape hatch to go out of network if you need to.
That's a perfect way to put it. All right, moving right along, let's talk about EPOs, exclusive provider organizations. Another hybrid, it seems.
Yep, the chapter describes them as having characteristics of both HMOs and PPOs.
Right on. EPOs, they're generally more flexible than a traditional HMO. You can usually see in-network specialists directly, no referral needed, kind of like a PPO. But here's the kicker, like HMOs, they usually don't cover anything outside their network unless it's an emergency.
So you have that direct access within the network, but you're really limited to that network for non-emergency care.
Exactly. They often fall somewhere between HMOs and PPOs in terms of cost, those monthly premiums.
Okay, so a good middle ground in terms of pricing and flexibility.
Yeah, sure.
Gotcha. Now, last but not least, we have DMPOs, Discount Medical Plan Organizations. They sound a bit different from all the insurance plans we've talked about.
Yeah, they are. DMPOs, they're not actually insurance plans. They're more like discount programs. You pay a fee to join, and then you get access to discounted rates from a network of providers.
So it's like a Costco membership for healthcare.
Kinda, yeah. You're still responsible for paying the discounted cost of the services yourself directly to the provider. The DMPO just gets you that lower price.
Okay, so it's not insurance, it's a discount program. Important distinction.
Yeah.
And are these DMPOs regulated at all?
Yep. State departments of insurance keep an eye on them, and they're often owned by insurance companies or other associations, but they might not be available everywhere. Some states don't allow them.
All right, good to know. Now let's shift gears a bit and talk about group insurance plans. This isn't a specific type of provider. It's more about how insurance policies are structured, right?
You got it. Group health insurance is a policy that covers a whole bunch of people, all under one big contract, like employees of a company, union members, that sort of thing. It's super common, actually.
Yeah, most people I know get their insurance through their work.
Exactly. And group plans, they're usually a lot cheaper than individual policies, even if the employees are chipping in for the premiums.
That makes sense. Buying in bulk, you get a better deal.
Right. And group plans usually have this conversion privilege. That means if you leave the group, you can keep your coverage, though you'll have to pay the full premium yourself.
Okay, so it's like a safety net, making sure you don't lose coverage if you switch jobs or something.
Exactly. Now, there are a few things that make a group insurance plan, well, a group plan. First, you got to have an acceptable sponsoring group. That means the group can't exist just to get insurance. They got to have another reason for being together, like being employees of a company or members of a union.
Makes sense. It's got to be a legitimate group.
Right. And the insurance company, they issue a master contract to this sponsoring group, which makes them the master policy owner. Then each individual member gets a certificate of insurance outlining their specific coverage.
Okay, so it's like a main contract for the whole group and then individual certificates for each member.
Exactly. And as we mentioned, group plans are usually cheaper, and they tend to be more persistent, meaning they stay in place even as individual members come and go.
So less turnover, which probably helps keep things stable.
Totally. Now, when it comes to underwriting and managing risk for group plans, insurers approach things differently than with individual policies.
I bet. You're dealing with a whole bunch of people instead of just one.
Exactly. So for large groups, like those with over 100 employees, premiums are often based on their experience rating. That means looking at their past claims history.
So they're judged on their own track record.
Yep. But for smaller groups, insurers usually use community rating. That means they look at the overall health costs for a similar group of people in the same area.
So for small businesses, it's more about the big picture, the health of the community.
Right. And the key for insurers is to have enough people from the group participate in the plan to avoid that adverse selection problem, where only the folks who expect to use a lot of healthcare sign up.
Right. Got to have a good balance to keep things fair and affordable for everyone.
Totally. Now, when an insurer is thinking about insuring a group, they look at a bunch of different factors. They'll consider why the group exists, how stable they are, how long they tend to stay with the same insurer. That's the persistency. They'll also look at how the group decides who's eligible for coverage, whether employees contribute to the premiums or the employer covers it all, the group's past claims experience, the size of the group, the average age of the members, even the type of industry they're in and the kind of jobs people do.
Wow, that's a lot to consider. It's like they're doing a full background check on the whole group.
Yeah, yeah. They're trying to get a good understanding of the risk involved. Now, for individuals to be eligible to join a group plan, there are usually some requirements. Common ones include being a full-time employee, sometimes having to be over 65, and often completing a probationary period with the employer.
So there are some hoops to jump through. And once you're eligible, there's usually a specific time to enroll, right?
Yep. You usually have a limited window, often around 31 days, during the initial enrollment periods or the annual open enrollment. If you miss that, you might be considered a late enrollee, and you might have to prove you're in good health to get coverage later on. But those change-of-life events we talked about, those usually trigger special enrollment periods.
Right, so you have a chance to make adjustments if your situation changes.
Exactly. Now, another thing about group plans is they often have participation requirements.
Participation requirements, what are those?
Basically, they're minimum levels of participation that the insurer needs to see to make sure they have a good spread of risk and to keep costs down.
So enough people from the group have to sign up for the plan.
Right. And the requirements are often different for contributory plans, where employees share the cost, and non-contributory plans, where the employer pays it all. For contributory plans, you might need something like 75% participation, while non-contributory plans might require 100%. But those percentages can vary from state to state.
Okay, so there's some flexibility there. But insurers definitely want to see a good level of participation. Now, the chapter goes into some alternative forms of group insurance, like METs, multiple employer trusts. What are those all about?
METs are a way for smaller employers, those who might not qualify for group insurance on their own, to band together and buy coverage as a group. They usually need at least 10 employees to join the party.
So it's like a team effort, pooling their resources.
Exactly. The MET, it holds the main insurance contract, and the individual employers become members of the trust. Their employees get certificates of insurance.
So it's like they're all under one big umbrella.
Right. And METs can be fully insured, meaning they buy a policy from an insurance company, or they can be partially self-funded, sometimes using a third-party administrator to handle the claims.
Okay, so different ways to structure it depending on the needs of the group.
Yep. And employers usually have to sign a joinder agreement to join the METney, and these trusts are sometimes called 501c9 trusts under the tax code.
Gotcha. And how do these METs compare to MEWAS's multiple employer welfare arrangements?
They're pretty similar, actually. Sometimes the terms are used interchangeably. MEWAs also involve two or more employers teaming up to provide health benefits, usually self-funded. But because they're self-funded, they fall under ERISA, the Employee Retirement Income Security Act.
So that's a federal law that governs these types of plans.
Yep. And ERISA, it can sometimes override certain state insurance rules, which is something to keep in mind.
Okay, so federal law trumps state law in some cases. Gotcha. Now, what about self-insured or self-funded plans? It sounds like the employer's taking on a lot of risk there.
Yeah, they are. In a self-funded plan, the employer pays for their employees' healthcare costs directly instead of paying premiums to an insurance company.
So they're basically acting as their own insurance company.
Kinda, yeah. But to protect themselves from huge costs, a lot of self-funded employers get stop-loss insurance, which kicks in if their claims go above a certain level.
Okay, so it's like a safety net for the employer.
Exactly. And self-funding, it can give employers more control over their healthcare costs and how their benefits are designed.
So more control, but also more risk.
That's the trade-off. Now, administrative services only, or ASO plans,
Yeah.
they're often used alongside self-funded plans.
So what do they do?
Basically, the employer hires an insurance company or a third-party administrator to handle all the administrative stuff for the plan, like processing claims and managing the provider network, but the employer still pays the actual healthcare costs.
So they get help with the paperwork and logistics,
Mhm.
but they're still on the hook for the bills.
Exactly. Now let's talk about small employer group insurance. There are special rules and regulations for those, right? You bet. Generally, a small employer is defined as having between 2 and 50 full-time employees, though it can vary a bit depending on the state. And the ACA requires at least one employee in a two-person group to be unrelated to the other. Under both HIPAA and the ACA, small groups have guaranteed issue protection. That means insurers can't turn away eligible employees or dependents based on their health history.
So no discrimination based on pre-existing conditions.
Exactly. And insurers also got to offer guaranteed renewability, meaning they got to renew the policy each year unless there's a good reason, like not paying premiums or fraud.
Okay, so some important protections in place for small businesses.
Yep. And insurers are usually required to offer at least two different plan options to their employees, one with a standard benefit level and one with more basic benefits.
So some choice for the employees.
Gotcha.
Now, what about franchise health plans or wholesale plans? I haven't heard much about those.
These plans are a way for members of certain associations or societies to get coverage, even if they don't qualify for regular group insurance through an employer. The main difference is that with franchise plans, individual policies are issued to each member, and the association acts as the sponsor, but they're not the policyholder like an employer would be.
So it's a way for people who might not have access to group insurance to still get some benefits.
Exactly, and they're often used for really small groups or folks who might not be eligible for an employer-sponsored plan. They can be contributory or non-contributory too.
Okay, so more options for those who might fall through the cracks. Gotcha. Now, all these group insurance plans, they're affected by regulations at both the state and federal levels, right?
Absolutely. States usually have rules about how group plans can be advertised and marketed, and there are penalties for any shady practices. And when you have groups operating in multiple states, it can get a bit tricky figuring out which state's laws apply.
Yeah, that sounds complicated. So how do they decide which state's rules to follow?
Well, the standard practice is usually to go with the state where the policy is delivered to the employer. This is based on a legal concept called interstate comity. But of course, federal laws like ERISA, HIPAA, and the ACA, those apply nationwide.
Right, so it's a mix of state and federal regulations. Now, what happens when a group health plan gets terminated? Are there any safeguards for the people who are covered?
Definitely. For starters, an employer can't just stop paying premiums to cancel the plan without giving everyone at least 45 days notice. And when a plan is terminated, employees usually have the right to convert their group coverage to an individual policy without having to prove they're healthy.
Okay, so they have options, even if a group plan goes away.
Right. And of course, an individual's coverage can also end for other reasons, like leaving their job or not paying their share of the premiums. In those cases, there are options for continuing coverage, like COBRA.
Okay, let's talk more about those continuation and conversion options. The chapter mentions extension of benefits. What's that all about?
So, an extension of benefits is a provision that ensures that if you're in the middle of treatment for something when your group coverage ends, the plan will keep paying benefits.